Not a long video today, but it is going to cover some important ground pertaining to the Fed cut yesterday. So let's dive right into it, folks. We have seen a lot of volatility in the bond market. Really over the last 10 days, we've seen rates steadily increasing. In fact, the last 9 trading sessions, we've seen rates up every single day going into the Fed cut yesterday, when it became more and more clear that some of the recent inflationary news that we had received was likely going to give the Fed motivation to release commentary regarding the rate of future cuts. Remember that the markets had fully priced in the expectation that the Fed would move 100 basis points further downward in 2025. That expectation, even though the Fed did lower a quarter yesterday as expected, they have reset that expectation, and now the market is only pricing in 50 basis points of movements in 2025. The net result of that is, y'all, rates are up half a point over the last 2 weeks, is the bottom line. So let's dive into what Mortgage News Daily is reporting. As far as the national average is concerned, today we are sitting at 7.14%. That is a 30-year fixed rate conforming loan, national average according to Mortgage News Daily. 1 week ago, that average had us at 6.87%. And 2 weeks ago, it had us at 6.68%, which was a multi-month low. Got to go back to early October to find rates as low as they were 2 weeks ago. And now we've given all that back. We are now about 10 basis points above where interest rates were 30 days ago. 30 days ago, we were sitting at 7.04 in that Mortgage News Daily average. What does this mean as far as the CME FedWatch tool? How are they predicting future rate cuts? Again, there was a large likelihood of a Fed cut at the January meeting going into about the last 3 weeks. Today, there is a 91% chance of no cut in the January 25th meeting. If you look forward to the meeting in March, on the 19th of March, there's a 53% chance of no cut at that meeting. Remember that the CME FedWatch tool bases these projections on a dot map that voting members of the Fed generate, stating where they expect monetary policy to be over the next few months and even years. So it's a good predictive tool because these are the folks that make those decisions. So in any event, not great news for interest rates this week, y'all. Going to be very volatile trading through the remainder of the year because there's going to be a lot of folks that are off enjoying vacations. So when you have light trading, you see a lot of swings possible. So the smart money right now is to not float in the current environment. Most lenders, including us, have pretty respectable relock provisions. If rates go crazy lower, then there's provisions there. We're not going to lose a loan in an eventuality like that. There's float down provisions there. So there's really not much reason to not lock a rate the instant you have a contract with the kind of volatility that we're seeing now. In any event, I hope this is helpful for you and for your clients. We are seeing business pick up significantly, y'all. Folks seem to be excited about where the economy is headed. Consumer confidence is significantly higher. That is one of the key drivers for folks that are considering a big purchase like a home. So I am excited about where we are headed. My activity is way up. Appreciate all of you so much for the trust and faith that you have placed in us this year, and frankly, for the last 30 years that we have been doing this. Thank you so much for your trust in us. Stay blessed, stay safe. Merry Christmas, Happy New Year. We will not have a call next week. We'll pick it up possibly in the new year. If you have any questions, and of course, if you have scenarios or a buyer that you'd like for me to visit with, that's what we do for a living here. We'd be honored to take care of them. In any event, stay blessed, stay safe. We'll talk to you soon.